My greetings to everyone. In the ongoing series of Finance for Everyone, we have started with the concept of budgeting in the last session. So just a few recap about what budgeting is all about, and today we will be discussing about the financial products, services and the banking loans. So budgeting is basically the process of creating a systematic plan to manage your money and control your expenses. And this systematic plan is called as a budget. So we have a specific process of the budget in which we first define the goal, gather the data, reconcile the goal and data, create a budget, monitor the outcomes and adjust the budget. We have seen about different types of budget. The first was operating budget. The operating budget refers to day-to-day expenses and the sources of revenue, and they are further divided into major categories like revenue, salaries, benefits and non-salary expenses, followed by a capital budget. Capital budget refers to estimation of capital requirement which helps in purchase of large assets like property, equipment, IT systems, etc. And it is very important to highlight again the budgeting part, because owing to this particular expenses what we are going to incur in future, we need the loans. And so these two topics are connected like this. And it also helps in allocation of the funds, controlling of the risk in decision making and setting the priorities. Then we have a cash budget. Cash budget involves all the cash payments and receipt of cash from the revenue. The cash budget helps in management of cash flow effectively. Now basic rule is 50, 30 and 20 rule. That is, we have to divide our income into the three parts and allocate it according to the following percentages. 50% towards the needs like rent, food, minimum payments, credit card payments and other debts. Followed by dividing your income into three parts and allocating it into the following. Like we said, 50% towards the needs, basic needs. The next is your 30%, 30% for the wants such as trips or entertainment, and the last 20% towards the saving, which can include the debt. Now it is very important for all of us to do the budgeting because it helps in controlling your spending, it helps in achieving your financial goals, it helps in preparing for contingencies and emergencies, and last but not the least, budgeting also helps in saving of the money. We have a budget surplus and we have a budget deficit. So let us have a look on what it is. A budget surplus is a situation when income or revenue exceeds expenditure, and the budget surplus is a situation when income or revenue exceeds the expenditure. In case of a budget surplus, additional money can be reinvested or used to pay off the debts. Now, let us see the concept of what budget deficit is all about. A budget deficit is a situation when expenditure exceeds the income or revenue, and in case of budget deficit, additional money needs to be raised in order to meet the deficit. Budget deficit is a situation when expenditure exceeds the income or revenue. The following example which we did in the last session was between A and B, and the total salary was about 6 lakhs each for A as well as B. The bank interest was 30,000. The dividend for Mr. B was 30,000, and the sale of land for Mr. A is 70,000 and the sale of gold for Mr. B is 70,000, which makes a total of 7 lakhs each. Then the housing, transportation, educational and personal makes it 6,30,000 for Mr. A and 9 lakhs for Mr. B. So what is the incurrence and what is the inference of this particular table is very important, which needs a special mention. Mr. A has a budget surplus of rupees 70,000, that is 7 lakhs minus 6,30,000, and Mr. B has a budget deficit of 2 lakhs, that is 7 lakhs and 9 lakhs. So there are some very important strategies to reduce the budget deficit. For this, you need to know your monthly income. In order to reduce the deficit, one must know all sources of its monthly income, and in case of the higher deficit, an individual many times search for extra income sources like part-time job, overtime job, incentive-based working, commission, etc. The second is know your monthly expenses. Similarly, in order to reduce the deficit, one must know all the sources of its monthly expenses, and in most of the cases, monthly expenses is inconsistent. Monthly recording of all the expenses can help tracing the unnecessary expenses. In case of a higher deficit, an individual reduce or cut down the unnecessary expenses like personal expenses, and the personal expenses may include laundry, cell phone service, clothing, personal care products, etc. Then the next step is plan your spending to match your income. This is the last step to reduce the deficit, is to match your expenses with your income. By reducing your expenses and increasing your income sources, an individual may raise its saving. So this can be explained with the help of an illustration. Let us have a look on this. The sources of income includes first the salary, that is 6 lakhs, saving account interest, that is 30,000, fixed deposit interest, that is 10,000, the part-time job, the commission, and the total makes it 6 lakhs 40,000. The housing, transportation, educational and the personal expenses, the total of it comes to 9 lakh 40,000. So, in this particular illustration, Mr. B has a budget deficit of 3 lakhs, that is 6 lakh 40,000 minus 9 lakh 40,000. So, Mr. A must find new sources of income in order to raise its income levels, followed by this may also include a part-time job, commission and the bank interest. Let's suppose Mr. A also work in a part-time job of rupees 10,000 per month and gets a commission of 1 lakh per month per annum. So, in this case, his total income will be 8 lakh 60,000 per annum. So, there is an addition of 2 lakh 20,000. Now, coming on to the sources of income. The sources includes the salary, the saving account interest, the fixed deposit interest, part-time job and commission, the total of which comes to 8 lakh 60,000. Similarly, Mr. A also reduces its unnecessary expenses like personal expenses, cell phone services, clothing, personal care products, etc., which may also impact its deficit. So, let's suppose now Mr. A only spends rupees 1 lakh on its personal expenses. In this case, his total expenses will be 7 lakh per annum. There is a fall of 2 lakh 40,000. So, let's say in case of Mr. A, the expenses includes the housing, transportation, educational and the personal expenses, the total of which comes to 7 lakh. Now, after following the strategies to reduce the budget deficit, Mr. A now have a budget surplus of rupees 1 lakh 60,000. Let's say the sources of income, the salary is 6 lakh, saving account interest is 30,000, fixed deposit interest is 10,000, part-time job is 1 lakh 20,000 and the commission is 1 lakh, which makes a total of 8 lakh 60,000. And on the similar pretext, let us have a look on the expenses of Mr. A, which includes the housing, transportation, educational and the personal expenses, the total of which comes to 7 lakh. Now, investment options in case of budget surplus. The first is your mutual funds. The mutual funds are considered to be more safe option to invest in the stock market in case you do not have the knowledge about the stock market. The next is to start with a small or a mid-cap mutual fund is definitely a very good option. Then we have investment in the government schemes. The government has provided various opportunities for investment. For example, Public Provident Fund, National Pension Scheme, National Savings Certificate. They are few government schemes where you can invest with the least risk. Another option is the gold bonds. In India, gold is a much loved investment option. Rather buying gold, you can invest in gold bonds. Gold bonds are much more secure options as compared to direct buying of gold. The gold bonds also provide you the interest income of 2 to 3% per annum. Gold bonds are guaranteed by the Government of India, and this also ensures the safety of your hard-earned investments. So, next we are going to talk about a very special topic, that is banking products and services. So, we start with the types of the bank loans. The commercial banks, it refers to a financial institution that provides various financial services like accepting deposits and advancing loans. So, in a way we can say that commercial banks are the intermediary organizations in which the people who save and the people who need money, they connect the two. That means they accept the deposits on the one point and they give loans on the other. So, the lenders as well as the borrowers are on the same footing when you talk about the commercial banks. The deposits received by banks are not allowed to remain idle, because once the money is there in the banks, it will not grow unless and until it is given in the form of advances or loans. Because once you accept the deposits from the public, you have to pay the rate of interest, and when you have to give the money to the people who want, that is the borrowers, or when you are advancing the loans, the bank has to receive the interest. So, the difference of which is the amount of income what the banks earn or what the commercial banks does. So, the deposits received by the bank, they are not supposed to remain idle. So, after keeping certain cash reserves, the balance is given to the needy borrowers and the interest is charged from the bank, which is the main source of income from these banks. So, by looking at the concept of the commercial banks, it's a very simple principles that the people who want to save and the people who want to borrow, they can contact the commercial banks. The people who will save will get the interest, and the people who will borrow the money, they have to pay the interest. But definitely, the amount which is paid in case of the public deposits are much less than the amount what they charge in case of advancement of the loans. This is what is called as the banking business. In other words, a certain part of the cash received by the banks as deposit is kept in the reserve and the rest is given as loans. Now, sometimes the amount which the bank receives in case of the deposits is suppose 1 lakh, and immediately there is a requirement of 80,000, 90,000 or more than 1 lakh. So, bank will not just going hayway. They have a bank policy, and the Reserve Bank of India has announced certain percentage which the banks have to keep with themselves after keeping that cash reserve ratio or whatever is the percentage which is changed from time to time as per the economic conditions or as per the changing norms of the country, that amount the banks have to keep in the form of cash and the rest of the amount is given as loans. So this particular rules has to be followed by the bank. So certain part which is kept in the form of cash is called as CRR, that is the cash reserve ratio. Now coming on to the different type of the advances or the loans which are given by the bank. The first is unsecured loan and the second is a secured loan. So as the name suggests, in case of unsecured loan, it is a particular type of a loan. A lender provides loan to the borrower without any collateral security, and it's normally given in case of the borrower's strong credit worthiness and economic stability. And in any case, the borrower's default, strict actions like a poor loan credit score, the legal actions, etc., could be taken. So as the name is very clear, in this particular type of a loan which is called as unsecured loan, nothing is taken as a collateral, nothing is taken as a security. That is, in case of a default, that particular security, if it was there, would have been used to pay off the loan. But this type of a loan for the banks is very risky. Why? Because you are giving the loan just keeping into consideration the credit worthiness, the credit score and the economic stability of the borrower. So you're not sure whether the loan will be returned in that particular stipulated period of time. So you see different factors into consideration and then take a decision to give a loan. That is, you generate the credit score of that individual, that particular borrower, and of course, if he is unable to pay the loans in time, then of course a strict legal action is taken against that borrower. The interest rates are usually higher than the secured loans. So as we have discussed, there are two types of loans, the secured loans and the unsecured loans. And if you compare the rate of interest of the two types, that is secured as well as unsecured, in case of unsecured loans, the rate of interest is higher compared to the secured loans, because in the secured loans you have a particular collateral with you, you have a particular security with you. It could be gold, it could be land, it could be anything which is precious. So in case there is a default, so that particular collateral security can be used to pay off the loans. So that is why this is the basic center of this particular argument, that why the rate of interest is more in case of unsecured loan and less in case of a secured loan. Higher interest rates is usually set up to compensate for no collateral requirement. So this particular argument is also very important for all the students to understand, that we always have this kind of a notion, they want loan, they don't understand the basic nuances of what is a secured loan and what is the unsecured loan. So this is the time when you have a very clear understanding of what is a secured loan and what is a unsecured loan. The collateral requirement is mandatory in case of a secured loans, which is on the other hand not mandatory for an unsecured loan. And that is the why the interest rates differentials are also present, which is more in case of unsecured and less in case of secured loans. Now, let us discuss the different types of the unsecured loans, out of which the first which I am going to explain is what is a personal loan. Personal loan is type of a loan, it is the most popular type of a loan and easy unsecured loan in India. This is one. Personal loan can be taken for any kind of a requirement like medical expenses, travel expenses, renovation of your home, etc. So when an individual simply goes to the bank and asks for a personal loan, so basically it is to fulfill the personal requirements which they might have in the future. For example, there is a sudden illness in the family. So you want the medical expenses to be covered by some loan. So if you're traveling somewhere abroad, you don't have that amount of money with you. You want to do some kind of a renovation in your home. You want to buy some kind of an assets which need the money and you don't have. So definitely in order to envelop that kind of needs, which is definitely personal in nature, you go in for one type of a loan which is called as a personal loan. So these are the few personal loan details which are there on the screens. Like we have the loan requirements of HDFC, then we have a loan requirement of different other banks which are present here. So the rate of interest, when you talk about the loan amount what you're talking about, the amount of the loan what you're talking about is different from an individual to individual. The persons who are wealthy, they have the credit score which is very good, they don't have any history of any kind of a default, they will easily get a personal loan. But the people who are having fluctuating income, the people whose credit score is not good, so the people will not be successful in getting a good amount of the personal loan. So these are the few illustrations with the help of which you will understand that it is different for different individuals, and there are many factors which are taken into considerations when the loan or the personal loans are given in this case. And when you talk about the top personal loan schemes and offer, so we have a particular bank, what they give, what are the key highlights, like there are certain banks which give a loan up to 30 lakhs only, the tenure is 5 years only, and similarly the people who are self-employed, their tenure, the amount of loan and the interest what they have to pay is different from the person who has a personal fixed income or the salaried class. So when you talk about the different types of the loans, what the unsecured loans are we talking about, it is not in the uniform perspective is not there. It is a differential perspective what we keep in mind, and the differential perspective is there in terms of the amount, in terms of the bank, in terms of the tenure, in terms of the interest rate, which is the main perspective and which are taken into consideration in order to finalizing the personal loans. So these are the particular rate of interest of the personal loans. It could vary between 10.15 per annum to 36% per annum. And the interest rate also depends upon the amount of the loan, your credit scores, and the repayment tenure, which is definitely a main option.